The first indicator we are going to talk about here is the simple moving average, or the SMA. And even though the simple moving average, as you can hear on the name, is simple, it's actually a great moving average and it's critical to learn about. Not only to use the simple moving average to actually trade, but the simple moving average is also a moving average that is found in many other indicators. So definitely guys, don't skip that chapter. Next, we are also going to take a look at the EMA, or the exponential moving average. This is one of the most common and one of the most popular moving averages, and this is for a good reason. So far, I have been showing many examples of where we use the exponential moving average, but I haven't talked about how the exponential moving average actually works. Next, we're gonna start talking about some more sort of exotic moving averages. The first one we're gonna talk about is something called the Hull moving average, or for short, HMA. This one is amazing and you will soon understand why. But another moving average we also of course have to talk about is the AMA, which stands for Adaptive Moving Average. Last but not least, and this might surprise you guys, we are going to talk about something called moving average, convergence, divergence. And you're probably familiar, or if you have been trading for a while, you're probably familiar with this indicator. This is the MACD. If you didn't know, the MACD, as you can actually hear on the name, is actually a combination of moving averages. You combine moving averages to get momentum signals. So I'm going to talk a little bit about how this works and go a little bit deeper into how moving averages affect the MACD. Alright guys, so now we're ready to take a look at the most iconic moving average, the simple moving average. And if you think this chart right here looks familiar, it definitely is. This is the example we have been using a lot in this video. So why not continue using this example? And by the way, guys, right now we are in TradingView. This is an amazing sort of trading platform suitable for everything from complete beginners to more advanced traders. And if you want to get started with TradingView, I will make sure to leave a link both in the description and the pinned comment that you can use to sign up for free. And if you want to, you can also do a TradingView premium trial for 30 days. And also, if you use the link and then later on decide that you want to upgrade to, for example, a premium or even an essential plan, you will actually get a $15 bonus. So make sure, guys, to use the link down below if you haven't, started with TradingView yet. But now, how do we open up the simple moving average? What we want to do here is that we want to go up here to the indicators tab in TradingView. And here, in order to find the moving averages, you don't want to search for simple moving average. You will be able to find it. But the best way to search here is to first search for moving average and then simple. So I don't know why it is in this order, but the simple moving average is called moving average simple. So feel free to start this one. And now let's open this one up. So now the moving average has appeared here on the chart. And the first thing you can notice here is that when you first open up the moving average, you can see that the moving average doesn't look very useful. It's pretty much hugging the price here very tightly. And that is because when you open up the moving average, the standard setting here is an SMA 9. And as you guys know, this means that the simple moving average is based on 9 days. So now the first thing we have to take a look at is how do we change the length of the moving average. To do this, we want to navigate up here to the upper left corner and we want to press on the settings tab right here. Then you want to make sure that you navigate here to the inputs tab for the moving average. And you can see that the first setting here is the length. So this is how long do we want the moving average to be. So for example, if we change the length to 20, now we have an SMA 20 on the chart. If we want to change the length to 50 and have an SMA 50, we simply choose 50 here and we will have a 50-day moving average and so on and so on. But for now, let's keep this one at 20 right here. And let's actually go up to the settings tab once again. Here on source, we have a few different settings. The close here basically means that the moving average bases its calculations on the closing prices, but you can change this setting. For example, the OHLC4 here will make it so that the moving average base its calculations on the open, high, low, and close of the candle. This is a pretty common setting, but the most common one, especially for moving averages, is actually to use the closing prices here. And what I also like to do here is to go to the style tab, because the normal line is so sort of tiny. So I like to increase the thickness a bit here. I can actually increase it by a lot in this case, so you guys clearly can see. So now we have a 20-day moving average here on the chart, but let's say that we want to have another moving average. One way to open up another one is to simply open up another moving average. And now, because we have this one starred, you can see that this one will come up right away. But if we unstar this one, we can simply search for moving average simple once again and open up another one. So now we have two moving averages, and if you want to change the settings of the second moving average, it's the same process. Let's say we want a 100-day moving average. We choose 100 right here. Let's say we want to change the style and color here. We can, for example, change this one to orange, and we can also make the lines a little bit thicker here. So right now on the chart, we have a 20 SMA right here, and we have a 100 SMA right here. As you can see up here in the left corner, you can see that it says SMA 20 close and SMA 100 close. But now guys, let's take a look at our second moving average, and that is the exponential moving average. So the first thing I want to do here is that I want to remove the simple moving averages on the chart. To do this, we simply go up here to the upper left corner, and we want to press the remove button right here and remove button right here. Then we navigate up here to the indicators tab, and remember, you want to search for, first of all, you want to type moving average, and then you want to type the type, so exponential. So here we have the moving average exponential, or EMA. So let's open this one up. And once again, to the normal EMA here will be based on 9 days, which you can see here up in the corner. And to change the settings, we do the same thing. We go up here to the settings tab, go to inputs here, and let's, for example, choose 20 for this example. And I also just want to make this one a bit more clearer so you guys can see. Okay, so now we have an EMA 20 here on the chart. And in order to understand how the EMA works, I think the best way to demonstrate this is to compare it with the simple moving average. So let's go up here to the indicators tab once again, search for moving average simple. And to make a good comparison here, we go up, let me remove that arrow. We go up here to where it says SMA 9. We want to change this one so we have the exact same length on both the SMA and the EMA. And we also want to change colors, so you can see. Let's change it to orange and a thick line like this. So now the orange line is the simple moving average, and the blue line is the exponential moving average. And the most important difference between these moving averages is that the exponential moving average will react faster to price movements, or in other words, it will give more weight to recent price action. So for example, as you can see right here, when the crash started, you can see that the exponential moving average, or the blue line, started to fall faster compared to the simple moving average, or the orange line. So even though the exponential and simple moving average have the same length, the exponential will react faster. And the same thing is also true during the reversal. So as you can see right here, the exponential moving average reacted faster to the movement towards the upside. It started earlier compared to the simple moving average. And this right here is a reason why many traders prefer the exponential moving average. Especially traders that focuses more on short-term movements can benefit from the faster reactions of the EMA. Okay, so now the time has come to take a look at the HMA. And the HMA is a newer moving average. It was developed by a guy called Alan Hull, and that's why it's called the Hull moving average. And this moving average actually has two goals. It wants to both improve the responsiveness of the moving average, while at the same time improve the smoothness of the moving average. And the calculations for the HMA is much more complicated than both the SMA and EMA. But this right here is not something you have to worry about. Now, let's take a look at how we open up the HMA in TradingView. Once again, we go up here to the Indicators tab. And for some reason, for this indicator, you want to first search for Hull here. And that is actually enough. If you search for Hull, you should see the Hull moving average coming in here at the top. So let's open this one up. And once again here, you can see that the standard settings for this moving average looks pretty useless. You can see that the line is sort of hugging the price right here. So it's definitely recommended to use a longer period. You can see that the standard period here is 9. And for this case, to demonstrate, let me actually increase the length all the way up to 50 here. And as for the style, we can increase the thickness a bit here so you can see it much more clearly. And now, as you can see, we have a very sort of smooth and very responsive moving average here on the chart. In order to show you guys how responsive this moving average is, let me actually open up both an EMA, so moving average exponential. Let me also open up a moving average simple. And we want to make sure, of course, to make, the length 50 of both of these. We can make the EMA to orange, and we can make the SMA another color. Let me make this, for example, purple. And let's increase the thickness once again. So now we have 3 moving averages here on the chart. We have the purple line, which is the SMA. We have the orange line, which is the EMA. And we have the blue line, which is the HMA. And what I want you guys to notice here is, first of all, how big of a difference the sort of responsiveness is between these moving averages. So for example, the Hull moving average reacted to the crash all the way up here. So pretty much when the crash started. The EMA took a little bit longer time. You can see it reacted down here, while the SMA took the longest time to react. So the HMA is much more responsive compared to the EMA and the SMA. But interestingly enough, you can also see that the HMA has a more sort of smooth movement. You can, for example, see that the EMA goes a little bit up and down, and you can also see that the SMA goes a little bit up and down, while the HMA prints a very smooth line. So what are the pros and cons of the HMA? Well, one thing that can of course be a benefit is the improved responsiveness. So if you are a short-term trader that needs to make quick decisions based on, the most recent price movements, the HMA can be a great choice. But one downside with the HMA is that because it reacts so quickly, you will see that we will actually get many false signals. You can, for example, right here, the price broke below the HMA, right? But then it quickly pushed above. You can also see that many times during the uptrend here, the price actually broke below the HMA. So the improved responsiveness can both be a sort of good thing if you are a very fast-paced trader, but it can also be a negative thing as well. And remember from earlier in the course, what I always recommend here is that when you trade based on moving averages, you want to, in order to take better trades, you want to combine it with other technical analysis techniques like market structure. I highly recommend learning about market structure. I highly also recommend learning about price action. All right, so the next indicator we're going to cover is the LAMA, or simply ALMA. The ALMA indicator, I would say, is more similar to the HMA compared to, for example, the simple moving average or the exponential moving average, but it uses a different approach and it also has some different settings. So to show you guys the ALMA, the first thing I want to do here is that I want to cross out the SMA and I want to cross out the EMA. But I actually want to keep the Hull moving average so we can compare it with the ALMA. And now we're ready to open up the indicators. So we go up here once again to the indicators tab. And now I think you want to search for ALMA, like right here. And the indicator you want to open is this one right here. I will not even try to pronounce this, but it's Arnaud, Legoux, blah, 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 moving average. And you want to open this one up. And as you can see, now the indicator has appeared here on the chart. And as always, it's not very useful with the standard settings. So we right away want to change the settings here. And here on the settings tab, you can see that the settings look very different compared to, for example, the SMA or even the HMA. Because here we have actually 3 different setting type. And the first setting, where it says window size, this is actually pretty much the same thing as length. And because we use the HMA 50, we want to make sure to change the length here, or the window size, to 50 here. But as you guys can see, we also have a setting called offset, and we have a setting called sigma. And the reason for this is that ALMA uses a different type of calculation called Gaussian distribution. You definitely don't have to learn Gaussian distribution, but it is quite important to know that it uses a different method. And changing the offset and the sigma values here will affect both the smoothness and responsiveness in slightly different ways. But for this video, to keep it simple, let's actually keep the offset here at 0.85 and let's keep the sigma here at 6. The standard settings are there for a reason and they are pretty solid. Next, we want to go here quickly to the style tab so we can make a comparison. I'm going to make this one orange and a bit larger. And now we're ready to go down here and press OK. So now the blue line here on the chart is the HMA and the orange line here is the ALMA. And the first thing we can notice is that just as for the HMA, the ALMA is, very smooth. And what we also can notice is that with these settings, you can see the HMA reacts a little bit faster than the ALMA. You can see right here, it's a tiny different. But here at the bottom, you can also see that we have quite some difference, both on the time scale, but also on the vertical axis as well. So now you guys might think, isn't the HMA a better moving average because it reacts faster? For example, it predicted the crash here earlier compared to the other moving average. And it also predicted the reversal here earlier compared to the ALMA. And while this is true, remember from earlier in the video that this can be both a good and a bad thing. As we talked about earlier, you can see that for the HMA, the price actually during the uptrend here dipped below multiple times. While for the ALMA indicator, we can actually see that the price stayed above the moving average. And also before the COVID crash, you can see that the ALMA moving average acted as better support. So here we have a trade-off. Do we want a more responsive moving average while at the same time getting, many false signals? Or do we want a less responsive moving average that respects the trends better? And here the answer to this question will depend on a few things. Such as, what are you trading? Are you trading, for example, a very volatile altcoin? Or are you trading, more stable stock or forex pair? And it also, of course, depends on what is your overall trading strategy. If you, for example, focus on breakout trades, the ALMA indicator might be a bit better. And why is this the case? Well, as we talked about, the HMA would see many false breakouts. But if you're using moving averages only to identify trends, perhaps using the slope of the HMA will perform better. So now, last but definitely not least, let's take a look at the moving average, convergence, divergence, or for short, the MACD. First of all, let's open up the MACD indicator, and to do this, we once again head up to the indicators tab and we simply search for MACD right here, and you want to open up the indicator called moving average, convergence, divergence. And now the indicator should appear here at the bottom of the chart. And let's actually begin here by making the MACD to a full screen. And to make you guys see the MACD a bit more clearly, I'm gonna change the thickness of the MACD line and the signal line like this, and now we're ready to press OK. Alright, so first of all, the MACD indicator consists of 2 lines. We have the blue line right here, which is the MACD line, and we have the orange line right here, which is called the signal line. And now you may of course wonder, how are these lines related to moving averages? Well, the MACD line is actually equal to a 12-period exponential moving average minus a 26-period exponential moving average. while the signal line is a 9-period exponential moving average of the MACD line itself. So this orange line right here is basically an average of the blue line. And because of this reason, when the blue line crosses the orange line, the slope of the orange line will shift. As you can see, once again here, when the MACD line crosses the orange line, the slope of the orange line once again shifts to the upside. And what you also can see here is that we have sort of peaks and valleys of the MACD indicator. What is the meaning of these peaks and valleys? Well, these peaks and valleys basically measures the distance between the orange line and the blue line. So as you can see, when the blue line is above the orange line, like right here, we will have a peak. And as long as the blue line is below the orange line, we will have a valley, like right here and right here. And it is the distance here between the blue line and the orange line which will determine how deep the valleys are or how high the peaks are. And you can use these peaks and valleys as a measurement of momentum. You can, for example, see that when the COVID crash started here, the MACD saw strong bearish momentum, and when the price started to reverse here, we saw strong bullish momentum. But this right here is a way too simplistic way to use the MACD. And unfortunately, I think the MACD indicator needs a whole video on its own because it's a very useful indicator, and I could probably spend, 30 minutes or an hour just talking about the MACD. So yeah, guys, if you're interested in seeing a full MACD video in the future, let me know that down in the comments below. But before we wrap up here, I also want to show you guys the settings real quick here for a MACD. So we go down to the settings tab and we go here to inputs. And as you can see, if you want to, you can change the settings of the MACD. We can change how the MACD line is calculated. Remember, we have a short period moving average, which is the fast length. We have a slow length moving average, which is the slow length. And you can also change the length of the signal smoothing as well. And you can change here the type of moving average. So the standard type here is the SMA, but you can change it if you want to an SMA. And in theory, you could use an HMA or even an ALMA indicator as well. Alright, so this video was actually just a clip from our full moving average trading course right here on YouTube. To access the full course, simply click or tap on the screen right here. I hope I will see you all over there very, very soon.